These are the top 10 most critical aspects to understand in order to be a profitable trader. Let's start with position sizing. So position sizing is pretty straightforward. It's how we deal with how much percentage of the account that we want to risk. So this could be anywhere from 0.01% of the account per trade all the way up to 1 to 2%. But really it should be around 1%. So the way this is calculated is just the distance between the entry and the exit, or the stop loss. So in this example, we have a long position, betting the market is going to go up. How we determine our risk is the distance between where we enter and where we would exit if the trade goes against us. So in the instance that the trade goes against us, we would lose approximately 1% of the account on the upper bounds of risk. So let's imagine you have a $10,000 account, although it's going to be different for everybody. Some people might have bigger, some people might have smaller. Ideally, at the upper bounds of risk, we really only want to be risking about $100 per trade. But this does not mean that when we buy something, we're only buying $100 worth. In fact, because we have a stop loss, oftentimes it'll be a lot more. There's another video on the channel where I go a little bit more into detail on how that works, but for example, we could have a position that's worth $5,000. And if it moves against us enough, then we only lose $100. Now, if we were holding this to 0, then the position size would only be 100. But the fact that we're not holding it to 0 and we have a stop loss means that the position size can be a lot larger, even while only risking 1% of the account. Okay, let's talk about opposite of martingale. So you guys have probably heard martingale before, which I don't agree with, and obviously it's been debunked as it doesn't work. But the opposite works quite well. So what does that mean? It means that let's say that we've taken 3 trades at 1% risk each, and all 3 of those trades amounted into a loss. So the overall drawdown in that case would be minus 3%. This is where we want to take a break for the day. Now there's a multitude of reasons as why we would take a break for the day. A lot of it comes down to emotions. So over trading, revenge trading, basically taking trades that you wouldn't normally take if you weren't staring at negative 3%. So then we come back the next day, or some people might take a couple days, but let's say you come back the next day. Instead of risking 1% of our account, now we're going to be risking 0.5% of our account. Because we know, so we go from 1% to 0.5, because we know that we're going to be a little bit more emotional. We might not take the best trades or take trades that we wouldn't normally take, again, because we're sitting in drawdown. Now let's say that happens again. Then we do it again and we go to 0.25% until we've made the money back. We have to go reducing our risk because we know that we're going to be emotional. Now let's say we finally get the money back. Then we can bump it back up to 0.5, and when we get the money back again, we can return back to our normal risk. This is paramount, and I know it seems simple, but the hardest part is actually following it. The concept itself isn't overly complicated, but following it is the hardest thing for people to do because they can't look at negative 3% in their account. It doesn't sit well with them. And so instead of going this route, a lot of the time traders will bump up the risk to say like 5% because they want to get this money back as quick as they can. And that might work a couple times, but eventually that's a slippery slope and a bad habit to build, which could lead to blowing up a massive part of the portfolio or even the entire portfolio. Okay, so that's just the basics of how you reduce risk when you're having losing days and how you can regain the account without blowing up the account. All right, let's talk about hedging. Now, hedging is pretty straightforward. It basically means that you're betting against your bets. So let's say that you have a position or a multitude of positions that's betting that the market's going to go up and they're well into profit. In this case, the example, you'd hit your profit targets. Let's say that you close 80% of your position. As long as you have a bulk profit target, pretty much anything above 50%, all the way to like 99%. But in this instance, let's use 80%. Let's say you have multiple of these running. And they've all hit their profit target. So you've closed 80% on multiple longs that have all worked out, which means that you have multiple 20% that are still not closed. Say you have like 3 of them, for instance. So times 3, you'd have around 60% of the original risk still in play. And so that's a pretty healthy runner if the market wants to continue to go up. So what you can do is now you can start to look to take shorts. Now the shorts that you take, you want to make sure that they're smaller than the 60%, unless you have an extreme bias that the market is going to pull back. But in most cases, we've been in a bull rally for a very long time across the board for most assets. So it's safer to take smaller hedges on short positions that also come with profit targets. So your shorts will also have profit targets as well, right? Same thing. Let's say that you opened up a short position. It's doing quite well. You close 80% of it here, and then you have 20% as a runner. And by the way, I didn't mention this, but in both these scenarios, you can bleed your stop loss into profit after you've secured that 80%. So you've got multiple longs with only 20% remaining on them, but when you add them all up, it's still 60%. And all of those longs have stop losses and profit. And now you can start to hedge and go short on some of those positions to bet against it, just in case the market does end up going down significantly. And so you're protected on both sides of the market, and you can make money on both sides of the market while protecting yourself. It's a basic into hedging. There's other complicated, different ways you can hedge, by looking for uncorrelated assets or using multiple financial instruments inside of any given asset class and sort of betting on the good ones to go up and the bad ones to go down in the same asset class because they usually trend the same way. But that's the basic for hedging. Let's talk about slippage. Now, this isn't a huge deal if you're trading very liquid markets with a small account. But if you're trading with a big account, you have to worry about slippage. So what does this mean? It means the difference of where you wanted to exit and where you actually exit. So let's say that this position doesn't work out. This is where you plan on exiting at the bottom of the red box. So you plan on selling your position here to market participants who are looking to buy in the event that the market goes past your invalidation. If there's not enough market participants willing to buy, or there's a bunch of other people with the same invalidation that you have, then the market will go down until it finds enough demand to fill your sells. And slippage is the distance between the stop loss, or where you wanted to exit, and where you actually exited. This can happen as well in common stock. It's called gap risk. Because common stocks, like the stock market, open and close, they're not 24/7. Sometimes the market could close here, and then the next day it could open down here, and then you've inquired that slippage via gap risk. But that's why for trading, you don't really want to trade common stock. If you had to, you would go into the options market because there's significant less gap risk, or the futures market. But regardless, we want to make sure that when we exit where we wanted to exit and not incur slippage because there's not enough demand to meet the supply that we introduced to the market. There's a multitude of ways to do this, and I'll speak later about that. And it's certain strategies you can use surrounding like laddering your positions and understanding the depth of liquidity of the order book relative to your position size, which is important. But for this video, I'm not going to go too in detail on that kind of stuff. And then we have set and forget. Set and forget is super important. It's pretty straightforward, like most of these concepts. It's just mainly the hard part is actually doing it, right? A lot of these concepts are not overly difficult. In trading, as you know, one of the biggest things is following your rules, and this one is the most important. Well, one of the most important, I should say. So set is pretty straightforward, S-E-T. It just means stop loss. So up here, let's say we're taking a short position. Stop loss, which would be the top of the red box, or where we want to invalidate our short trade if it's not working for us. The E is entry, right? So the E in set is entry. And then the T is target, or take profit, where you plan to close a portion of the trade if it works in your favor. Once we have, let's say the market is right here, it has hit our entry. Once we have our exits, our stop loss, and our profit targets, in which case you should actually have multiple profit targets, but I'll talk about that a little bit later. Once we have our stop loss and our target, the trade is close-ended, meaning one of two things will eventually happen. It'll either hit our stop loss or it'll hit our target, but we will eventually be exited out of this trade. So knowing that, why would we mess with the trade after it's live? A big mistake, and I used to do this as well, but a big mistake I see is, let's say the market's up here in the red box and it's floating here, and you're thinking to yourself, oh, it's gonna stop me out, it's gonna stop me out, so I need to close it now, that way I can minimize the loss. And then once you do that, the market turns around and hits your profit target, but you've closed the position at a loss. This is one of the main reasons you should use set and forget. Again, once you have your stop, entry, and target, you can forget about the position until it is closed by the market. You could look for new positions, or just sit on your hands and wait. And then the other scenario is, let's say that it's going in your favor and price is sort of hovering by your profit target. You might think to yourself, oh, I need to lock this in because it's going to reverse against me. And so you cut your winner short, and then the market eventually goes a lot further. Remember, in trading, the only way that you'll survive and the only way you'll make it to profitable, at least for a long time, is very simple. You cut your losses early and let your winners run. If you've cut your winners early and let's say you move your stop loss so you extend your losses, then you've done the exact opposite. So once you have a plan, you must stick to it. And if you get stopped out, that's why there's position sizing, opposite of martingale, so that's why we protect our downside. Because no matter who you are, how good you are, whether you're an institution or not, you will have losing trades. And we need to become comfortable with this idea that sometimes we will lose, and that's okay. It's one of the beauties of the market. Okay, in the next part, I'll talk about the rest of this, which is laddering profit targets, how you should have your risk reward, strategy, which I know a lot of people are interested in. This is more complex stuff and isn't as simple to explain in a short video, but I'll try my best to sort of summarize a lot of this stuff in the next part. So you can check it out on the channel. Like I said, there's another video of me explaining position size more in detail, which is this one up here. Already posted on the channel, but thanks for watching, guys. See you in the next one.